Should I also sell during a market sell off? Whether it is during the recent COVID 19 related market dip or the 2008 financial crisis, among others, investors have faced many market sell offs in the last 50 years. In fact, experts say sell offs are part of the DNA of financial markets, as they could signal that investors are taking profits off the table, rebalancing their portfolios, reacting to the latest developments, or addressing their own liquidity problems. So, what should you do during a sell off? Sell, hold tight, or do something in between? Welcome back, folks, to another edition of City Kiwi. How you doing today? I hope you are doing fantastic. I'm doing marvelous, if you were to ask me. If you are doing as terrific as I am, go grab a cup of coffee or tea or vodka and let's roll. Today, I want to talk about whether or not you should sell during a market sell-off. Before we answer the question, let me just say that markets go up and down all the time. If you look at history, and you can go all the way up to nearly 100 years ago when we had the 1929 the global depression, you can see that in the last 100 years or so, markets have gone through periods of up and downs. They have gone through peaks and troughs. So going up and down shouldn't be a problem, really. So the next time we have a market dip, don't panic. It will happen again. That's for sure. It will happen again. So you got to look at history. You also got to look at the current situation. Are things really that bad? Because what happens is Chairman Alan Greenspan, the former chairman of the Federal Reserve, said this a few years ago when he talks about irrational exuberance. In other words, investors, and the whole trading game, the whole financial markets, they're just an ecosystem of emotional propensity, emotional exuberance. What I'm trying to say here is that people don't think. People are just panicking. They just sell things. They sell good companies like Tesla. It was kind of funny if you go back in April or March, especially on March 23rd, 2020, Tesla went below 400 for the first time and went back up afterwards. What I'm trying to tell you here is that people are scared. They start making decisions that may not be rational. So you got to look at the current situation. You have to look at the underlying reasons why the market is selling off, and sometimes, you can see that it's really not a strong reason. In other words, the sell-off does not have momentum. If we just take an example with the latest sell-off related to the COVID-19 crisis, the global pandemic, you can see that there was no real reason for the sell-off. It was just a mass movement. It was just mass panic, and people just started unloading their portfolios, their holdings. So look at the underlying reasons, and also look at the real state of the economy. Is the economy really that bad? A lot of experts are saying no, the economy is strong. It's just that we're going through a temporary, I would say, hard moment. Let me call it that way, tough moment. So markets, folks, go up and down all the time. And sell-offs are part of life. They're part of the DNA of financial markets. Next thing I want to talk about is, are you a short-term investor or a long-term investor? Let me ask you that question. This is a really important. And what is long-term versus short-term here? Long-term means that you are buying a stock or a bond or ETF or mutual fund, and you are just holding it for a long time, for more than a year. That's the technical definition of long-term versus short-term. Short-term means that you are holding the security for less than a year, for less than 12 months. So a short-term investor can be a day trader, a pattern trader, or a swing trader. So a swing trader is someone who's looking for movements within a stock and is trying to get in and get out. Now, a swing trader is not a day trader, because a swing trader actually can hold positions after more than a day. A day trader is mostly someone who is just trying to close all positions at the end of the day. They generally don't hold positions overnight. So you got to think about that. So if you're a short-term investor, then the answer to that question, should you sell during a market sell-off, it will be different than an answer given to someone who's a long-term investor. So a long-term investor, again, as I said earlier, it's someone who is in the buy and hold process, buy and hold approach. You do analysis, you buy and you hold. Now, another element that I want to really mention is that decisions about selling off when there is a market sell-off have tax consequences. They have fiscal consequences. If you are a long-term investor or whether you are a short-term investor, the tax consequences are different. I will speak about that later on, but I just want to mention it now because and the tax consequences are not the same. So whether we're talking about capital gains tax or just being taxed at the ordinary income tax bracket, if you're being taxed at the capital gains tax, you're being taxed at a lower rate. The maximum is 20% currently. So you have 10%, 12%, 12.5%, 15%, and 20%. Those are the four tax brackets. But if you are being taxed at the normal rate, the ordinary income rate, then you can go as high as 39% or 35% at the moment. I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another edition of Sweetie Q. We're also having a conversation here around whether you should sell. You should also sell during a market sell-off. Now, I've already talked to you about the fact that markets go up and down all the time. That's established. And I was also have asked you that you need to determine whether you are a short-term investor or long-term investor, because the answer to the question, should you sell during a market sell-off, has implications and depends upon the nature of the relationship you currently have with the financial markets, whether you're a short-term or long-term investor. Now, before you sell, please consider a few factors. Do you have immediate liquidity needs? Do you need money for everyday life? Do you need money to put food on the table, on your family's table? Do you have kids that need to go to school? Do you need money? Do you need cash? Is the ka-ching in your bank account right now kind of going low? Do you have short-term liquidity needs? So short-term liquidity needs are different from immediate liquidity needs. Short-term liquidity needs include things like if you have to take care of big ticket items. I'm talking about buying a car or a house. What is your time horizon? How old are you? Are you in your 20s, 30s, 40s, or nearing retirement? Because your time horizon will have a major impact on whether or not you should sell during a market sell-off. If you're young, if you're in your 20s, you have a lot of time, so you can wait. The market could always rebound. Actually, not could. They always do rebound. The question is, how long would it take for them to rebound? But if you are, let's say, in your 50s or late 40s, you don't have the same flexibility, chronologically speaking, than someone in his or her 20s. How likely is the stock to recover? That's another question you need to ask yourself before deciding whether you should sell or hold. How likely is the stock to recover? And you can do this by reading the news. We have a lot of resources out there having some kind of intel on the industry, because the stock is linked not only to the recovery of the stock has several implications, not only for the company itself but also externally. So is the stock likely to recover? And also, before you sell, you have to think about your personal financial situation. Do you have enough cash in the bank? I'm not talking here about immediate liquidity needs. I'm talking about, do you have enough cash in the bank for stuff like emergency funds, your retirement accounts? How are you faring financially? Do you have a stable job? Is your job at risk of are you at risk of losing your job? Are your couple's finances okay? There's another question. If you are in a relationship, if you're married, you want to think about things globally. You want to look at things more contextually. So if any of those questions lead you to selling some of your holdings, then go ahead and do it, because you need the money, because you need to eat. Your children needs to eat. Things need to keep going. And so God forbid, if you lose your job and you just are going through a temporary cash crunch, you need to you need to sell. Now, should you sell if you are a short-term investor? Depends. Depends. It depends on what? It depends on whether you are a swing trader or a day trader. If you're a day trader, in other words, the technical definition is you are maintaining a daily P&L, profit and loss statement. So you are constantly, every day you are constantly seeing whether or not you made money or lost money. If you're a swing trader, that means that you can actually wait a few days or even weeks. So it really depends upon your situation, and it depends upon what I said earlier about the likelihood of the stock recovery, your understanding of the overall market. Do you need money? What are the recovery odds for companies whose shares are being sold off? The thing about the financial markets is that you cannot analyze companies idiosyncratically. You cannot analyze companies individually. They're part of a composite. They're part of a sector. They're part of an index. There is the external movements that have an effect and some kind of consequences on the performance of the individual stock. What I'm trying to say here is that to determine whether or not you should sell as a short-term investor, you need to determine whether, one, the company itself is still good, so the probability of recovery of the stock is high, and number two, that the same recovery applies to other companies whose shares are being sold off. Let me give you an example. I personally bought in April or March. I bought a lot is a big word, but I bought some stocks in the pharma sector, thinking that, hey, listen, with this global pandemic here, there is a possibility that one of these companies will come up with a vaccine, some kind of medication to stem the progress of this virus. Did I make some money? I did. Did I lose a little bit too? I did. But my point here is that, and what I've seen is that a lot of companies in the pharma sector were rising. It was a sector-wide trend. So what you have to think about things not only individually, idiosyncratically, but also collectively. You also have to pay attention to the overall portfolio risk profile. How, if you sell as a short-term investor, how is that going to affect your portfolio risk profile? Is that going to leave you with too high a concentration in a particular industry? In other words, if you sell your big pharma stocks, are you going to be too concentrated on, say, finance or technology or tech companies? The idea here is to constantly look for that diversification and the asset allocation. I'll be back right after this. Don't go anywhere. Welcome back, folks, to another edition of the Awesome Sweetie Kiwi Show. We're still having a conversation here around whether or not you should sell during a market sell-off. So I gave you the answer about selling if you are a short-term investor. Let's talk about if you're a long-term investor. Should you sell? Should you sell if you are a long-term investor? That's the big question. That's the $1 million question. Now, answer here is kind of similar to what I said earlier. It depends. The general rule is do not sell. If you are a long-term investor and your time horizon is kind of cool, you have margin, you have some kind of, you can breathe, you have breathing room, say 10 years, 20 years, do not sell. The only exceptions, there are a few exceptions. Do not sell unless you have liquidity needs. Your financial situation has changed. So things have not been going great for you lately. So your job is at risk of being lost. You have debt levels going up. Your credit cards is mounting. You have no cash coming in to pay your credit card debt. Things are not going well in your relationship. The children are there. They need money. They need money for a lot of stuff. And God forbid, you have to take care of medical bills. So if that's the situation, I'm painting, listen, guys, I'm actually painting a grim picture here, but this is just intentional. It is, again, don't forget, this is hypothetical, but I'm just trying to show you here how extreme things can go and should go before you consider selling if you are a long-term investor. Do not sell unless the company or sector may not recover. We've seen a lot of sectors in the, for instance, the oil and gas industry suffering a lot during the last sell-off, the one that happened in March and April 2020, because of the fact that a whole transportation has been brought to a halt. Airlines, ships, the global supply chain has been brought to a halt. So that could be a reason why you want to sell. You can also sell if the stock no longer fits in your portfolio profile. So your portfolio risk profile does not have a criteria that align with the stock anymore. Remember though, and I think I said that a little earlier, that whenever you sell as a long-term investor, you have to think about taxes. So if you sell at a profit, you're going to have capital gains tax of 10, 15, or 20%. You also have to pay income on dividends, right? So if you sell and you receive dividends before selling, you have to pay income on dividends. The company, your brokerage, will send you 1099 that's 1099-DIV, where they will report the dividends to you, dividend income. And if you the capital gains, you have to pay taxes on that too. Now, if you sell at a profit. Now, if you sell at a loss, there's a sweet secret I want you to remember. Do something called tax harvesting. Tax loss harvesting. Tax loss harvesting. It means that you are selling losing stocks and profitable stocks simultaneously. And why you're doing this? Because you're trying to offset the profits with the loss. So if you have a few stocks that you want to get rid of, then now is the time. So if you're selling at a loss, make sure that if you have some profitable stocks, also do this tax loss harvesting. We have covered this topic at length in another show. So please just look into our library of shows and avail yourself of that show. Another question is, what should you do when the market is, so let's say, what should you rather do? Sell or not sell? But what should you do just as a long-term strategy? Whether you sell or not, you have to think about three things. And I call this ADR. You need to think about asset allocation, diversification, and portfolio rebalancing. You need to rebalance your portfolio. This is very important. Again, you do this irrespective of whether or not you sell. What is asset allocation? Long story short, asset allocation means that you are choosing which assets you are putting your money into. And the asset classes include stocks, bonds, cash and cash equivalents, ETFs, exchange traded funds, mutual funds, and so on and so forth. Cash and cash equivalents include things like money market accounts. You have short-term bond funds. You have CDs, certificate of deposits. So asset allocation means that you're sitting around and say, listen, I'm going to put 50% of my money into stocks. I'm going to put 30% of my money into bonds. And I'm going to put 20%, I'm going to keep 20% in cash. That's asset allocation. What is diversification? Diversification means that you are actually saying, listen, within the cluster of stocks that I buy, I'm not going to be concentrated. I'm not having a concentrated position. I'm going to spread the wealth across multiple sectors and multiple companies. So for instance, for stocks, you can buy tech, finance, consumer staples, energy, commodities, travel. The idea here is to be diverse. Of course, diversification, right? Do not put all your eggs in the same basket. And then we have rebalancing. You need to rebalance your portfolio. In other words, you need to sell overweight positions and buy underweight ones. Rebalancing your portfolio is tightly linked to asset allocation. So if, let's say, you have said at the beginning, I want to have 50, 30, 20, and then stuff happens, after a sell-off, you've seen a change in that proportion, in that mix. So now stocks are at 40, 30 and maybe 30, then you need to rebalance that. And how do you rebalance that? You rebalance by selling off overweight positions that have made a lot of money, and you buy positions that have lost a lot of money. So those are the underweight ones. Before I end today's conversation, please, this is a pro tip. Don't try to time the market. People are talking about selling off. Should I sell? Yeah, I've given you the answer based on your style, whether you are a short-term investor or a long-term investor. But regardless of anything, please don't try to time the market. Remember that time in the market is more important than timing the market. Let me repeat that. Time in the market is more important than timing the market. The thing is, you just want to get in. Do your research, fundamental analysis, technical analysis, and once you are comfortable about the position, just get in and wait. Go chill, go somewhere, go to Acapulco, relax. All right? Thanks so much, folks, for listening to this conversation. I will see you next time. But until then, remember, stay marvelous.